Not a lot can be more devastating to investors than a disappointed expectation. This week we talk about what is normal. If history has shown us one thing, it's that the market works over time. The economy works over time. And the reason for that, as we've suggested, is not any kind of magic. It's all the entrepreneurs, innovators, and even workers that get up every day and get after it. And yet there is this disconnect between what the markets have borne out over time and what studies have shown many investors get within their portfolio. And that disconnect is led because of disappointed expectations, a belief in what should happen. And when that doesn't happen exactly over a time period that maybe the investor wants or thinks that they need, the emotions start to run, the emotionally charged decisions start to occur, and that's where all sorts of counterproductive behavior comes in. Again, the key to that is the markets work over time, not necessarily the way you would want them to all the time. So this week we're going to talk about what is normal about some of the things that have gone on lately within the markets, and what are maybe some of those things that aren't so normal right now that investors need to be aware of. First is what is normal? It's volatility. I know it doesn't feel like it because, again, it's not something any of us enjoy. As we've told you in the past, the same part of our brain that triggers when we're in mortal danger gets triggered when we're losing money, and volatility makes us feel like we're just in this free fall that will never end. Of course, our more rational parts of brains, history, statistics, let us know that's not going to be true. And yet, when those emotions get going, it's so tough. When I think about the markets and volatility and how normal it is, I've referenced before a great Chris Rock bit where he talks about the Tiger incident attack on Siegfried and Roy years ago, and how people were like, man, that tiger went crazy. And he retorted, that tiger didn't go crazy, that tiger went tiger. I.e., just like markets, it was doing what it is naturally meant to do. It just didn't align again with people's expectations, and so they called it, like they'll call the markets, crazy. Volatility, after two back-to-back years of 20% gains, certainly reared its head here a bit of late. A week ago Monday, you had the DeepSeek news that rocked markets in general, specifically tech names, and very specifically that darling tech name that we all know about. And again, people thought, man, the market is going crazy. Arguably, what was crazy was the run-up before that. But again, people love a 20% market return for the markets, and so they're happy to go along with that, even if in fact that may not be what's normal. This chart really shows you just how normal volatility is. It's a look back over the last 45 years, a lot of red dots. And what those red dots represent are the intra-year declines at some point during the calendar year of the market. A few things should stand out. One, lots of red dots. Market dropping, and even dropping pretty precipitously, is common. In fact, the average intra-year market decline is 14.6%. What's abnormal is a year, if you can find it, like 2017, where there's virtually no volatility and the intra-year decline was less than 5%. That's the anomaly. As much as we may like it and enjoy those moments, that's what's abnormal. The more important takeaway of this is, despite all this volatility, as I started the video with, the market will work over time. If you look at that, most of those years end up with a gray bar pointed to the upside. That's the final return for that calendar year. And if you look at it holistically over the whole time, over 75% of those years end up with a positive return, despite what in some cases have been some pretty significant intra-year drawdowns. So if this volatility is normal, and most importantly to take away, not fatal or to be feared, if anything, to be taken advantage of, that's another video. What is abnormal about the markets right now? Well, as I suggested a moment ago, 20% returns in back-to-back years, despite a historic equity market average of 9%, that's a little bit abnormal. But again, if you look out, we've talked about this over time, just like periods of volatility, market returns to the positive tend to come in very lumpy methodology. You rarely get anything approaching average. What's not normal about the markets right now that we've been talking about, telling people that they need to consider, look at their allocation, are current equity market valuations, specifically the S&P 500, and even more specifically, those handful of high growth names within the S&P 500. Much like periods of low volatility, everyone is happy to look the other way as these things trade at lofty valuations of over 50 times earnings, put up spectacular returns. We love that kind of abnormal activity. The problem is that kind of abnormality, at some point, history would suggest comes with a cost. And as we saw last Monday, for some of those darlings, very swift pullbacks if any of those expectations aren't met. One of the hardest things for investors to get along is you can have a great company. You can have a company making great earnings, but if you don't buy it at a great price, it may not result in a great outcome. And that is very difficult, again, for a lot of people to get their heads around. The next charts will show you, number one, just where we're at right now. The S&P as a whole trading at nearly 28 times earnings, which is this first chart. The second chart, which you've seen over and over again because it's just that important to us, is that historic correlation between price paid, value of what you're paying for something, and future looking 10-year returns. All the blue dots you're seeing are actually rolling 10-year periods. That yellow line, again, is just that mean return over time and expectation. And what you'll see, if you were just to go blindly by the market and history was to hold, is at 28 times earnings, there have been no blue dots that have registered a positive return. And even that line comes in at 0%. Now, none of us can predict what's going to happen, but probabilities, histories, valuations certainly matter over time and need to be taken into account. The good news is there's plenty of places trading at attractive valuations. There is certain methodologies to be employed to get you through those periods of volatility, to help mitigate too much exposure to those high valuation points. And that's exactly what we're going to touch on next week. Thanks for joining.